to Chapter 2 of LaSalle's 2024 ISA Outlook, all about our real estate strategy in Europe. Dom Silman, Petra Blashkova, and I look forward to sharing more on our outlook for Europe with you in this presentation and Chapter 2 of the 2024 ISA Outlook. European property markets enter 2024 after a year in waiting mode. Waiting for a peak in ECB and Bank of England policy rates, waiting for an end to the war in Ukraine, and waiting for bid-ask pricing spreads to narrow. This waiting can be put down to a bout of altitude sickness in Europe after our steep alpine climb up the mountain of interest rates. But markets are acclimatizing to this change. Those ready to move out of waiting mode with a strategy underpinned by realism about the operating environment and conviction in target strategies are likely to benefit in the year ahead. Here in Europe, we believe those conviction strategies are debt, strategies rooted in extreme supply barriers, and select operational real estate sectors. European economies enter 2024 after sidestepping some of our worst fears on recent energy and banking crises. The region no longer depends on Russian natural gas, a remarkable 2-year transformation. Tourism has surged back, and unemployment in the European Union is near record lows. This has supported solid residential and retailer space demand and led to a strong recovery in hotel revenues. Yet, we expect headwinds to have the upper hand over the coming year, with our region sitting on the cusp of recession. Inflation is moving in the right direction, yet the higher ECB and Bank of England rates that this inflation has induced are just beginning to bite. That rate shift and the changing expectations around the rate shift is captured well in these graphs of SONIA and Euribor forward curves. Mortgage rates for homeowners are an important transmission mechanism between these higher rates and the real economy. More European borrowers will see their spending power reduced by mortgage payment increases in 2024. Notably in Sweden, the UK, Netherlands, and Spain, where variable or fixed converting to variable mortgage products are more common. Moreover, the shadow of 2022's bond market reaction to British Prime Minister Truss's mini-budget hangs over not just the UK, but also over other European markets with significant government deficits, Italy in particular. This imposes fiscal constraints that limit how governments can respond in a downturn. These factors together are reasons to expect weak near-term economic conditions in Europe. Yet, as we look ahead longer term, there are 5 trends that give us conviction that Europe's property markets will bounce back from these short-term headwinds and that will continue to earn the region an important place in investors' property portfolios.
Firstly, Europe's city centers are truly getting back or even exceeding pre-COVID levels of vibrancy, footfall, and from a real estate perspective, occupier demand. Long-awaited infrastructure projects are underway, and those completed prove powerful in bringing life back to cities. In London, Crossrail finally opened as the Elizabeth Line, or another good example of creating real estate demand in new locations is Grand Paris Express, due to open for Paris Olympics in 2024. Now it's important to realize that these dynamics in Europe's city cores are creating a gravitational pull for occupiers to relocate from peripheries to more central locations. The second trend is more secular, and it relates to decarbonization, the investment and innovation in the sector. This is not just government regulations, but increasingly being prioritized by private organizations and individuals. Proof of this is visible in market data, given the price of carbon is very close to its record high and 3 times higher than 2020 prices. In European office markets, tenants' actions are speaking loudly too. LaSalle's analysis of announced large tenant relocations in London shows that occupiers are choosing BREEAM Excellent rated buildings with EPC of B or better. A third trend is migration, representing an upside surprise to many. 2022 saw a tragic and massive displacement of people from Ukraine, especially to Poland. But Europe's relative openness to migration is an advantage, even if sometimes it's underappreciated. European countries that best integrate these arrivals have an edge and stronger long-term potential. A fourth European trend to watch is the changing complexion of the European Union. The EU's last new member, Croatia, joined a long time ago in 2013. EU growth, possible enabled through a future membership including Ukraine, but not only Ukraine, could support long-term growth and reduction of trade barriers. Lastly, EU property markets stand out for their high presence of inflation-indexed leases. High single-digit inflation has continued to be translated directly into revenue growth over the last year, and it helps offices, logistics, retail, and sometimes residential cash flows.
When it comes to capital markets, though, transaction volume is down sharply, and values have declined over the last year by the most we've seen since the global financial crisis. All property types in Europe have seen yields rise, and although the UK has reflected these changes faster so far, we think that in the final analysis, the underlying shift in values is likely to be pretty similar across the UK and the EU. This is not unusual during major capital market dislocations. As we can see in this chart, where the rows are space, so every row represents a European city and property type pair, and the columns are time, so that every column represents a quarter-on-quarter valuation change for a particular quarter, with the most recent quarters on the right. Red is falling values, so we can see the GFC over there towards the left, where value falls were highly correlated. Value increases through yield compression, shown in blue, are both milder and more idiosyncratic, but cover wider stretches of time. As Brian Klinksack and Eduardo Gorab mentioned in the global chapter, once the peak in policy rates is generally believed to have been reached, we do expect to see transactions return and those bid-ask spreads start to narrow. Of course, the cost of debt remains a major concern in the market. While availability of debt, given that cost, remains pretty high, lenders are open for business, interest coverage ratios are a constraint now, in a way that they haven't been for many years, and this looks particularly troublesome for non-prime office stock, where we expect pressure on yields to continue as the search for a bid goes on. That divide in how investors treat differing quality in office stock naturally mirrors how occupiers feel about the quality of space too. The huge range of variance in outcomes between leading and lagging offices can no longer be captured by the concept of bifurcation, so that's why one of our global themes for 2024 is beyond bifurcation. So in London we now have a concept of super prime offices, which attract rents above where brokers consider prime rent levels to be. But to get there you really do need everything, including not just location, design and amenities inside and outside the building, but also the increasingly vital sustainability attributes. It's not only offices where stock selection is critical. Retail also has huge variation around the sector average depending on location, size and format. Assets that benefit from turnover-linked leases, such as outlet centres, may be well positioned to benefit from inflation as long as consumer demand keeps surprising to the upside. Elsewhere, already lowered rents and values have made many retail markets less tightly connected to risk-free rates. For that reason, we like retail parks in Spain, where we think the format works well, and the outlook for consumers is among the brightest in Europe. Speaking of consumer demand, we've seen logistics demand cool off, but the construction pipeline is shrinking and the long-term demand outlook remains very bright. With the increase in energy prices, occupiers are seeking logistics with sustainable features, both to control costs and to align their businesses with Scope 3 emission targets. The visual here is our European Path of Distribution score, which measures where distributors can reach the greatest number of consumers at the lowest transportation and labour costs. It rates Rotterdam and the Ruhr as the distribution centres of gravity for the continent. It's not just energy bills that increased the cost of housing in 2022 and 2023. The increase in interest rates on mortgages, as mentioned by Dan, combined with the huge displacement of people unleashed by the war in Ukraine, as Petra was speaking about, drove a surge in demand for rented residential that supply had no chance to keep up with. Most of Europe's rented residential markets are subject to some type of regulation. Investments in these markets may be relatively more attractive in a downturn, though while rents are still trending upwards, investors may opt to take on more exposure to operational strategies in more lightly regulated jurisdictions.
Our European investment recommendations align to 3 themes. The first of these is supply barriers. These barriers in Europe can be extreme, and they are rising. Paris, for example, begins putting their new urban plan into practice in 2024. We expect this plan will effectively prevent long-term growth in the city's office inventory. Moreover, demolitions and conversions, long an important driver and factor in European office markets, have helped keep office vacancy relatively low in cities like London, Paris, and Amsterdam. Redevelopment projects to create superprime assets in central submarkets are in part attractive because they and the skills to execute them are scarce as a result of these supply barriers. And the barriers don't stop with office. Residential undersupply in Europe is chronic. As shown in this graph, France, Germany, and the UK are set to undershoot their target for housing delivery, once again, very consistent with the 10-year average. Calls for a policy shift towards YIMBY, or yes in my backyard, approaches to planning, are likely to grow in 2024. Yet, recent history suggests that the opposing NIMBY, not in my backyard interests, will continue to be difficult to overcome.
Our second top European strategy theme is lending. With some banks pulling back, European alternative lenders are stepping into the gap. The ongoing need for refinancing means investors in debt funds can gain exposure to target sectors and geographies even when acquisitions markets are quiet. Unlike equity valuations, floating rate debt solves for repricing in real time, so LPs also benefit from the recent increase in interest rates and from the equity ahead of them to cushion the impact of any further value declines.
A third theme is operational real estate strategies. All real estate has some operational characteristics, but especially operational intensive strategies are distinguished by revenue and require more specialist expertise. There is potential to enhance efficiency, build platforms, and aggregate smaller assets into portfolios. We expect niche and residential markets to continue maturing in Europe over time and to provide a tailwind for exiting these investments. Especially, our outlook is strong for European limited service hotels, student accommodation, and UK private medical. Now turning next to our geographic recommendations. Our 2023 European Cities Growth Index, ECGI, shows Copenhagen and Stockholm rising into top 5, fueled by their favorable demographics and productive human capital, with Munich also not far behind. Across European cities, however, there remain 2 giants when it comes to growth. Together, London and Paris have expected economic output growth over the next 10 years equal to the next 9 cities combined. Significant allocations to best locations in these 2 markets remain essential for European property portfolios.
Thank you for joining us for this close look at Europe, and look out for forthcoming ISA Outlook 2024 chapters on North America and on Asia Pacific. We hope you continue to watch and read.